Guess what? The average 30-year fixed mortgage rate hit 3.7% on Tuesday, and that's according to the Mortgage News. And that's higher since April 2020 and almost 83 basis points higher than it was a year ago. This is Kiwi the Coast, your luxury real estate specialist, helping you maximize and sell the value of your coastal home. Don't forget to hit that subscribe button. Let's dive into all the interesting data. Rates are reacting to those surging bond yields. As financial markets react to swifter and more aggressive monetary tightening by the Federal Reserve, of course, mortgage rates do follow loosely the yield on the 10-year Treasury, but they're also affected by the demand for mortgage-backed bonds. Now, the Fed had been buying those bonds very aggressively through the pandemic, and that was in order to keep those rates low, if you remember. But now the Fed is pulling back more aggressively from the mortgage-backed security market than they were doing before. According to CoreLogic, the average homeowner gained over $33,000 of equity in the last 12 months. And the average equity on mortgage homes in America is approximately $216,000. Now, of course, lenders are trying to keep those rates down. Now, mortgage rates should be higher, but lenders are deliberately compressing those mortgage rates down by reducing and minimizing their fees and other costs. And that's to compete with lower margins in a very competitive marketplace. Some will be at 3.625, but most will be at 3.75%, which, let's face it, is still a very low interest rate. Lenders, of course, are losing vast amounts of refinance business. I mean, who's going to refinance their home to a higher rate if they already have that low rate? The refi boom, of course, has been very active over that last year, and it's starting to come to a close. And of course, we're seeing that because applications to refinance are down almost 50% from where they were a year ago. And that's according to a recent survey from the Mortgage Bankers Association. So you should ask yourself, how are these rates affecting the buyers out there? Are we still seeing huge buyer demand? Rising interest rates are not what future buyers want to see, of course, when they are on the cusp of the future busy spring housing market. Buyers of new homes are also concerned because what they're seeing is delays between when they sign the contract for a new home and when that home can be delivered. And this is due to supply chain issues with materials and, of course, labor shortages caused many cases by the Omicron surge. Now, those buyers can't always lock interest rates because they don't have a firm closing date for the new home construction. Buyers of those medium-priced existing homes out there, and of course that's around $350,000 in America, are now paying $125 per month more than they would have a couple of months ago. And this may price some buyers out of the market, especially those first-time home buyers on the lower end of the market. Hey, I hope you found all that information valuable. I certainly do bring it to you. Don't forget to subscribe to my channel so that you can stay up to date on all the changes affecting you and the real estate market. See you on the next video. The Room.